The stock market has taken a beating recently with the S&P 500 officially entering correction territory down around 10% from its February highs. Fears of inflation and President Trump's escalating tariff policies dominate headlines. So, are we doomed? It might seem so, but history suggests otherwise. In this video, let's look at the other side of this coin. Let's begin. On March 28, 2025, the S&P 500 dropped another 2%, closing below 5600. The Dow Jones Industrial Average fell by 758 points, around 2% again, and the Nasdaq Composite slid by 2.7%. This is because of the combination of fears around inflation and, of course, the Trump tariffs that have taken over the investing world right now. Consumer sentiment has also hit its lowest point since November 2022. Many Americans fear slower economic growth and higher unemployment in the year ahead. These factors have led to heightened market volatility. But corrections like these are not unusual. In fact, they might be presenting the best buying opportunities for you. Corrections occur when markets drop around 10% or more from recent highs. Since 1929, there have been 56 corrections in the S&P 500, averaging once every 2 years. Most corrections do not evolve into bear markets. Only about 40% historically reach that level. This suggests that while unsettling, these corrections are normal part of market cycles. The current correction is especially scary because of its speed. Generally, fast corrections are a result of panic selling and not economic problems or any fundamental reasons. Let's compare some corrections, but let me warn you, this correction is actually one of the fastest in history. The fastest correction ever was the pandemic crash in 2020. The S&P 500 fell 10% in just 8 trading days. The next is the trade war sell-off of 2018, triggered by escalating trade tensions. We saw a 10% drop in only 13 days. The next is when the market reacted sharply to President Eisenhower's health scare, reaching a 10% decline in just 16 days. After that, we have the Korean War of 1950, and the next one is what we are seeing today. The most recent correction takes the 5th place because it dropped 10% in just 20 days. But here are some facts that might make you feel better. If we look at the top 6, markets were actually higher 1 month later in 5 out of 6 instances. 3 months later, markets gained a median of 9%. 6 months later, markets rebounded in all 6 cases with strong returns. Markets typically recover half their losses within just 15 days after hitting correction levels. And over the past decade, corrections have consistently led to positive returns within 6 months. So is this similar to the previous 6? We'll find out pretty soon. By the way, if you're enjoying the video so far, hit like and consider subscribing. As I mentioned earlier, this current sell-off seems to be driven by fear rather than fundamentals. There are definitely some tariff concerns. While tariffs may raise costs in the short term, they rarely lead to long-term economic damage unless combined with severe stagflation, a scenario that remains unlikely given current data. Inflation is definitely elevated, but this is still far from hyperinflation levels as seen in past crises. And finally, we have a weakening consumer sentiment. While the sentiment has weakened, unemployment is actually low overall, providing some stability to the economy. Historically, these kind of concerns are short-lived because the market adjusts to new realities. And you should also adjust to new realities. That's why it's so important to stay with the market during such times. I'll be honest with you, for long-term investors with a time horizon of 5, 10, 20 years, this is definitely a buying opportunity. At least in my opinion, that's what I believe. These corrections basically allow us to buy quality stocks at good valuations. When there's a sale during Black Friday, everybody runs to buy some stuff. But when there's a sale in the markets, nobody wants to buy anything. And that is the fundamental problem. As Warren Buffett says, be fearful when others are greedy and be greedy when others are fearful. Don't do the opposite. The historical rebound pattern suggests that patient investors can benefit significantly after downturns like this one. Recently, I've been buying a lot of names and you should be looking at some of your favorite names too. I plan to buy next week as well and the week after that if I'm lucky. You should look at some of these popular names trading at good valuations. Mag 7 right now is looking quite good. Especially Google and Amazon are trading at amazing valuations. I've been buying them recently. Stocks like HIMS, Uber are also looking pretty good. Semiconductors are also trading at good valuations. I've been buying ASML and I've been eyeing Broadcom for quite a bit now. I might start accumulating soon. However, there are other names that are still looking expensive, so be careful anyway. So while fears dominate the headlines, history has shown us that these are great opportunities for patient and disciplined investors. As always, it's crucial to diversify your portfolio and avoid timing the market too precisely. However, if you stay invested through tough times like today, you will come out winning eventually with epic returns. On that note, I'll see you next week in a new video. Till then, keep learning and stay on top of your finances. Until next time.